14% gone in hours, from $116 to $99. Panic selling or strategic opportunity? Here's what the numbers aren't telling you. The gold-silver ratio just crossed a threshold. It hasn't touched in nearly 3 decades. 5 ounces. That's the hidden cost they're not calculating. And while everyone's asking whether to sell, the real question is entirely different. Because this pullback, it's not what it appears to be. And the next 72 hours will separate those who understand market mechanics from those who simply react to price movements. What you're about to discover changes everything you thought you knew about this correction. Welcome to Silver Radar, where we cut through the noise and deliver the economic intelligence that truly matters. Now, if you've been watching markets long enough to remember when silver traded in single digits, when a $100 ounce seemed like a distant dream rather than yesterday's reality, then you understand the value of seasoned perspective in volatile times. Do me a favor, one professional to another. Hit that subscribe button below, not because I'm asking, but because strategic economic analysis like this deserves a permanent place in your information stream. You've survived enough market cycles to know quality intelligence is rare. And before we dive into the numbers that explain why this pullback strengthens silver's position rather than undermining it, drop a comment below and tell me, where in the world are you watching this from? Are you observing these market movements from North America, Europe, Asia, or somewhere else entirely? Your geographic perspective matters because currency devaluation doesn't respect borders. Now, let's examine exactly what happened in these past 48 hours and why the conventional analysis is missing the most critical element of this entire correction. January 30th arrives with digital chaos across global trading platforms. Red dominates every screen monitoring precious metals markets. Silver's price display tells a story that experienced traders recognize immediately, 99.71 per troy ounce. The number itself appears substantial, even impressive by historical standards, but the context transforms celebration into concern. Down 16.61 in a matter of hours, a 14.33% decline that qualifies as bloodshed in conventional market terms. Rewind the clock just 48 hours to Wednesday, January 28th. The closing bell rang with silver commanding 116.61 per ounce, a price level that seemed to establish new psychological territory. $17 per ounce evaporated, not over weeks or months, but overnight. The technical definition flashes across analyst terminals. Correction territory officially entered. Yet this designation carries a critical caveat. The trading day extends for hours ahead. Final settlement remains uncertain. Current prices reflect opening volatility, not closing reality. Gold participates in this downward movement, but with notably different character. A 6.46% decline registers across gold markets, significant yet comparatively stable. The dollar amount tells its own story, $174 per ounce surrendered. In absolute terms, gold's loss appears larger, but proportionally, silver's decline cuts deeper. The gold-silver ratio undergoes transformation that seasoned precious metals analysts immediately recognize as significant. 2 days prior, the ratio held at 46.43, a level that sparked immediate conversation among institutional holders, now 51-1. This numerical shift represents more than statistical movement. It marks territory rarely visited in modern trading history. The ratio hasn't sustained levels below 50 since the late 1990s, making current positioning historically noteworthy. Monday's trading session provided advance warning that volatility had become the dominant market characteristic. Silver climbed beyond $117 per ounce during intraday trading, reaching heights that triggered profit-taking across multiple holder categories. Then, gravity reasserted itself. The same trading day witnessed prices collapse back toward $103, a $14 swing within hours. Not days, not weeks, hours. This pattern establishes a new operational reality for precious metals markets. 10% to 16% daily price swings have transitioned from exceptional to standard. Volatility no longer represents temporary market distortion and has become the fundamental characteristic of silver's current trading environment. Consider the psychological position of Wednesday morning's buyer, capital deployed at $116 per ounce. Conviction strong, momentum apparently confirmed. Thursday's opening bell delivers harsh education. Portfolio valuations decline by double digits, not due to fundamental collapse, but simple price correction. The mental calculation becomes unavoidable. How much additional silver could those same dollars purchase at 99 per ounce? The answer creates regret. Approximately 17% more metal for identical capital. Market psychology undergoes predictable transformation during such movements. Fear of missing out converts to fear of catching falling knives. Yet contrarian perspective suggests entirely different interpretation. Corrections don't represent market failure. They serve essential structural functions. Rapid price appreciation without consolidation creates unstable foundations. Parabolic moves lack staying power. They require periodic testing of support levels. The critical question emerges, will $100 hold as newly established floor? If silver closes today's session above the psychological century mark, despite morning's decline, the correction potentially demonstrates strength rather than weakness. Buyers who witnessed the pullback and observed price stability above $100 gain confidence. They've seen the worst of immediate selling pressure and watched support materialize. This dynamic activates the buy the dip mentality that characterizes accumulation phases. Strategic holders recognize temporary price dislocations as entry opportunities rather than exit signals. Smart money operates counterintuitively. Accumulation occurs during panic. Distribution happens during euphoria. The surface narrative focuses on percentage decline and dollar losses. But deeper analysis reveals market mechanics establishing new equilibrium. The fundamental question facing every holder crystallizes: is this pullback a problem requiring defensive action, or an opportunity demanding strategic response? Price movements alone cannot answer this question. Understanding requires examination of what surface numbers fail to reveal about underlying market structure. The anatomy of this collapse extends beyond simple supply-demand dynamics. It touches purchasing power realities, ratio relationships, and strategic positioning frameworks that separate reactive traders from calculated investors. What appears on trading screens represents only the visible dimension of a multi-layered market transformation. The numbers everyone sees mask the numbers that actually matter. A single kilogram bar rests on the dealer's counter. Scottsdale Mint branding gleams under fluorescent lighting. 32.15 troy ounces of refined silver compressed into rectangular form. The transaction receipt tells a story most market observers systematically ignore: $2,190 exchanged for this 1 kilogram bar. Calculator work reveals the per ounce reality. Just under $90 per troy ounce at time of purchase. The dealer offered a courtesy. Spot price hovered near $91. Negotiation produced $2,190 even. Round numbers facilitate clean transactions. Both parties benefit from simplified mathematics. This purchase occurred recently, silver trading in the high 80s, before the parabolic move toward $100 plus. Yet this acquisition exists within broader historical context that transforms interpretation entirely. Two identical bars sit alongside this recent purchase, acquired years earlier when silver operated in entirely different price territory. The archived receipts reveal uncomfortable truth. $700 to $720 secured 1 kilogram bars in that previous market environment. $20 per ounce versus $90 per ounce. The differential isn't marginal. It represents fundamental purchasing power collapse. Mathematics delivers the devastating verdict. Current capital buys 1 bar. That same capital previously secured 4 identical bars. 75% reduction in dollar buying capacity. Not theoretical. Not projected. Already executed and documented. This reality triggers the question echoing across precious metals communities. Should strategic holders exit positions at $100 per ounce? The psychological milestone arrives after years of anticipation. Silver below $30, then breakthrough to $50. Consolidation, then explosive move toward triple digits. Conversations held years ago resurface with new urgency. Would I actually sell my stack if silver hit $100? The theoretical answer came easily during $20 silver. Probably not. I'm a long-term holder. Conviction expressed in comfortable circumstances, when tested by reality, often reveals different truth. Yet the moment arrives. Silver crosses $100, reaches $116, then corrects back toward $90. Decision time materializes, not as abstract future scenario, but immediate present reality. The sale button exists, platforms stand ready, liquidity abundant, and the choice becomes crystal clear through inaction. Deep stack holdings remain untouched. No exit executed, no profit-taking initiated. Words previously spoken receive validation through actions taken or deliberately not taken. The selling pressure argument proliferates across digital platforms. YouTube algorithms promote videos advocating immediate exit strategies. Thumbnails scream "sell now" in attention-grabbing fonts. Comment sections overflow with urgent advice. Take profits before correction deepens. Lock in gains while you can. The logic appears sound on surface examination. Years spent accumulating at $25, $30, $35 per ounce. Now trading at $100 represents extraordinary appreciation. Percentage gains exceed 200% for many holders, 300% for early accumulators. Traditional investment wisdom suggests profit-taking at such levels: lock gains, reduce risk exposure, preserve capital. Yet this wisdom assumes something critical. That fiat currency received from sale represents stable store of value. That dollars acquired at $100 silver will purchase equivalent utility as dollars spent at $30 silver. The teenage memories resurface. Silver trading consistently in the 20s and 30s. Each paycheck allocated a portion toward metal accumulation. Steady, methodical, patient. The internal dialogue repeated constantly. If silver hits $100, I'll sell everything. Theoretical exit strategies formulated during accumulation phase. Confidence in future discipline. Recording this analysis with silver at precisely $99 per ounce, according to dealer websites. The moment of truth has arrived. Not as distant future, but present circumstance. And the answer crystallizes through revealed preference rather than stated intention. The stack remains intact. The conviction holds. The sale doesn't execute. This isn't about stubbornness or irrational attachment. It reflects deeper recognition that emerges only when abstract becomes concrete. Selling silver at $100 means buying dollars at $100 silver. The transaction works both directions simultaneously. What do those dollars actually purchase in current economic environment? The same $2,190 that bought 1 kilogram previously bought 4 kilograms. Reversing the transaction means accepting dramatically devalued currency as payment for appreciating asset. Inflation-adjusted analysis reveals additional complexity. Is $100 silver genuinely expensive when measured against currency debasement? Or does it represent appropriate repricing relative to monetary expansion? The nominal price creates psychological impact, 3 digits instead of 2. But real purchasing power tells a different story. Perhaps $100 today equals $30 adjusted for actual inflation, making current prices not high, but appropriately valued. This framework transforms the entire decision matrix. Selling isn't locking in profits, it's exchanging finite asset for infinite currency. The deep stack philosophy emerges from this recognition. Core holdings serve different purpose than trading positions. They represent wealth preservation across generational timeframes. Price targets become irrelevant when fundamental thesis centers on currency devaluation rather than metal appreciation. The goal isn't selling silver high, it's never selling at all, yet another strategic consideration demands examination. The gold-silver ratio has compressed to levels unseen in decades, creating apparent arbitrage opportunity. This mathematical relationship potentially offers wealth multiplication without currency exposure, if executed correctly. The chart loads across multiple monitors simultaneously. Gold-silver ratio, current reading flashes in bold numerics, 50.73 to 1. This number carries weight that casual observers systematically underestimate. Experienced precious metal strategists recognize immediately what this positioning represents. Historical database query initiates, data extending backward to 1995. 3 decades of ratio relationships compressed into visual representation. The pattern reveals itself with stark clarity. Time spent below the 51 threshold. Minimal, sporadic, brief. Late 1990s technology boom period witnessed temporary compression into the 40s. Capital flowed toward risk assets. Silver benefited disproportionately. Gold languished relatively. Then the long desert commenced. 1999 through 2006, 7 consecutive years, ratio consistently elevated above 50 to 1. Even periodic dips failed to breach the threshold meaningfully. Lowest touchpoint registered 56.31, still well above current positioning. 2006 and 2007 offered brief respite. Compression occurred, opportunity materialized, then evaporated. The 2011 event stands as an anomaly worthy of detailed examination. Silver's parabolic surge toward $50 per ounce. Gold appreciated, but couldn't maintain pace. Ratio compressed dramatically. Swap economics favored silver to gold conversion. Those who executed the exchange preserved wealth through subsequent correction. Silver collapsed from $50 toward $15. Gold held comparative stability. The swap protected capital. Post-2011 reality established new normal that persisted until present moment, 13 consecutive years, entire decade plus. Ratio maintained above 50 to 1. No exceptions, no meaningful breaches, no opportunities for strategic repositioning. Until January 2025, the breakthrough arrives without fanfare. Ratio compresses below the threshold that held for over a decade. Suddenly, the conversation shifts from theoretical to tactical. Should strategic holders exchange silver for gold, lock in ratio advantage, reposition portfolios? YouTube's recommendation algorithm activates with predictable enthusiasm. Videos proliferate, advocating immediate swap execution. Thumbnails promise once-in-a-decade opportunity. Comment sections transform into strategy debates. Exchange 46 ounces silver. Receive 1 ounce gold. The mathematics appear compelling on surface examination. Spot price ratio of 46.43. Exchange less than 50 ounces. Acquire 1 ounce gold. Historical context supports the trade. Ratio spent minimal time at such compressed levels. Mean reversion theory suggests eventual expansion back above 60 or 70 to 1. Those who swap now potentially multiply wealth when ratio normalizes. Yet this analysis contains critical flaw that invalidates conventional calculation. Spot prices exist in theoretical realm. Physical transactions operate in different universe entirely. The premium reality awakens, separating theoretical from executable. Gold bar purchases don't occur at spot. Dealers add markup for inventory, handling, margin. Typical premium structure, spot plus $75 per 1 ounce bar. Silver round sales don't fetch spot. Dealers subtract discount for buyback, processing, liquidity costs. Typical buyback structure, spot minus $10 per 1 ounce round. Wednesday's actual market numbers, before Thursday's correction, provide concrete example. Gold spot price closed at $542.49 per troy ounce. Silver spot price closed at $116.61 per troy ounce. Division produces 46.43, the ratio displayed on every precious metals website, but executable transaction prices tell entirely different story. Gold bar purchase price, $5,114.49 plus $75 premium equals $5,189 actual cost. Silver round sale price, $106.61 minus $10 buyback discount equals $106.61 actual proceeds. Now division reveals uncomfortable truth. $5,489 divided by $106.61 equals 51.50 ounces required. The 5 ounce gap materializes. Hidden cost of premium differential between buying gold and selling silver. Spot ratio promised 46 to 43 ounces. Reality demands 51.50 ounces. Difference of 5.07 ounces per transaction. This gap compounds across typical swap volumes. Trading 100 ounces silver, lose 10 additional ounces to premium differential. Trading 500 ounces silver, sacrifice 50 ounces to transaction costs. The mathematics remain favorable compared to historical norms, but significantly less attractive than spot prices suggest. Current market conditions further complicate the calculation. Thursday's correction pushed ratio back above 50 to 1 on spot prices. Real transaction ratio likely approaches 56 to 1 when premiums factor properly. Is this still opportunity, or has the window already narrowed substantially? The strategic decision framework requires examining multiple scenarios simultaneously. Bull case perspective. Wall Street silver community projects $200 per ounce this calendar year. If silver doubles from current levels, swapping now means surrendering future gains. Trade 50 ounces at $100, receive 1 ounce gold at $5,000. Silver reaches $200. Those 50 ounces now worth $10,000. Gold appreciates to perhaps $6,000. The swap costs $4,000 in opportunity loss. Devastating miscalculation. Bear case perspective. May 2024 witnessed silver trading at $32.99 per troy ounce. 8 months later, silver exceeds $100, appreciation surpassing 200%. Parabolic moves historically resolve through violent corrections. Mean reversion remains powerful force. If silver corrects back toward $50 or $60, the swap preserves wealth, perhaps even multiplies it, through defensive positioning. Historical precedent supports both interpretations. 2011's silver peak, followed by 70% decline over subsequent years. 2019-2020's gold surge maintained gains more effectively than silver's volatile swings. Yet 2024-2025's silver performance potentially represents different structural shift entirely. The individual decision matrix crystallizes around conviction rather than calculation. Do you believe silver's rally continues toward $150, $200, $250, or do you anticipate significant correction back toward double-digit pricing? Your answer determines optimal action. Mathematical favorability alone cannot override fundamental market view. The impossibility of perfect timing haunts every strategic repositioning. Selling silver at $95 to buy gold at $5,200, then watching silver climb to $130 creates regret. Holding silver at $115, watching correction to $65, while gold maintains $4,800, creates equal regret. No decision eliminates risk, only different risk profiles exist. Two distinct camps solidify across precious metals communities: bulls versus bears, conviction versus caution, momentum versus mean reversion. Wall Street silver represents the optimistic faction. The projection carries specific numerical weight: $200 per ounce, achieved within current calendar year. Silver's destiny according to accumulated analysis. Their logic flows from supply constraints, industrial demand acceleration, monetary policy failures, currency debasement inevitability. If this projection materializes, swapping silver for gold at current ratios represents catastrophic strategic error. Exchanging 50 ounces at $100, receiving 1 gold ounce at $5,000 appears reasonable today. Silver doubles to $200. Those 50 ounces transform into $10,000 value. Gold appreciates proportionally, perhaps reaching $6,000 or $6,500, but unlikely doubling. The opportunity cost becomes staggering. $10,000 potential reduced to $6,500 reality, $3,500 sacrificed to premature repositioning. Multiply this across serious holder positions, 100-ounce swaps, 1,000-ounce portfolios. The losses compound into generational wealth differential. Yet opposing perspective demands equal consideration. Bear case advocates point toward velocity of appreciation. May 2024 provides their starting reference. Silver traded at $32.89 per troy ounce, 8 months preceding current moment. The appreciation calculation reveals uncomfortable trajectory. $33 to $106 represents 251% gain. No asset sustains such velocity indefinitely. Physics applies to markets. Parabolic moves resolve through gravity. Historical precedent supports skepticism toward extended rallies. Every previous silver surge, 1980, 2011, resolved through violent corrections exceeding 50%. Mean reversion remains among the most reliable forces in financial markets. What rises exponentially eventually corrects proportionally. If silver retraces toward $50 or $60 per ounce, 40% to 50% decline from recent peaks. Gold maintaining comparative stability around $4,500 to $4,800 range. The swap executed today preserves wealth through defensive positioning. Trading 50 ounces silver at $100, acquiring gold at $5,000. Silver corrects to $55. Those 50 ounces now worth $2,150. Devastating portfolio impact. Gold declines modestly to $4,700. The single ounce retains $4,600 value. Wealth preservation achieved. The differential becomes survival mechanism rather than opportunity cost. Individual decision matrices require honest conviction assessment. Surface-level analysis provides false comfort. Genuine strategic positioning demands deeper examination. Time horizon consideration separates traders from generational wealth builders. 3-month outlook versus 3-decade outlook produces entirely different optimal strategies. Trading positions respond to technical levels, momentum indicators, volume patterns. Generational holdings respond to monetary debasement, currency collapse, civilizational shifts. These frameworks don't reconcile. They represent fundamentally different philosophical approaches. Risk tolerance evaluation extends beyond numerical volatility calculations. Can portfolio withstand 40% drawdown without triggering emotional selling? Does psychological constitution permit riding volatility through multi-year cycles? Honest answers reveal appropriate positioning better than mathematical optimization. The impossibility of perfection haunts every market participant. No trader in history consistently executed optimal entry and exit timing. Even legendary investors acknowledge systematic inability to call exact tops and bottoms. Yet analysis paralysis creates equal danger to impulsive action. Waiting for perfect clarity means never executing any strategic repositioning. Real-time recording of this analysis provides visceral demonstration of new market reality. Silver fluctuates from $97.90 to $101.35 during single filming session. $3 range, 3% volatility, compressed into hours rather than days or weeks. The old normal dies permanently. Stable spot prices become historical artifact. Nostalgic memory of simpler times. New normal acceptance becomes prerequisite for effective participation. 10 to 15% daily swings represent standard operating environment going forward. This volatility won't diminish. It intensifies as liquidity fragments and speculation dominates. Strategic positioning principle emerges from chaos. Informed decisions trump perfect timing. Conviction enables endurance through volatility. The valid argument acknowledgement matters critically. Both bull and bear cases contain legitimate supporting evidence. Dismissing either perspective as foolish demonstrates analytical arrogance rather than wisdom. Premium-adjusted ratio calculations, even at 56 to 1 real transaction cost, remain historically attractive. 3 decades of data confirm current positioning falls within rare opportunity territory. Yet opportunity only materializes if underlying thesis proves correct. Ratio compression means nothing if silver corrects 60% while gold maintains stability. The final assessment synthesizes correction analysis, purchasing power reality, ratio mathematics, conviction requirements. Thursday's pullback from 116 to 99, 14% decline. Surface narrative suggests weakness. Deeper examination reveals correction strengthens market structure rather than undermining it. Rapid appreciation without consolidation creates unstable foundation. Eventual collapse becomes inevitable. Pullback establishes support level, tests commitment, separates speculative money from strategic positioning. If $100 holds as floor through this correction, psychological level transforms into technical support. Future buyers gain confidence. Silver tested $100 and held validation through adversity. Volatility represents feature rather than bug in current precious metals environment. 15% daily swings don't indicate broken market. They indicate transitioning market from stable monetary regime toward unstable monetary experimentation. From predictable price discovery toward chaotic revaluation process, those demanding old normal stability, perpetually disappointed, constantly frustrated. Those accepting new normal volatility, strategically positioned, emotionally prepared. Navigate uncertainty with strategic clarity rather than emotional reaction. This principle separates wealth preservation from wealth destruction. The 14% pullback isn't problem requiring panic. It's natural correction within unprecedented appreciation cycle. Conventional analysis fails because conventional market no longer exists. Silver crossed into territory without modern precedent. Historical playbooks provide limited guidance. What matters now? Conviction in fundamental thesis, tolerance for volatility, patience through chaos. The pullback reveals who holds strategic positioning versus who chased momentum. Strategic holders view correction as validation. Momentum chasers view correction as betrayal. Your perspective determines whether this moment represents crisis or opportunity. And that determination, more than any mathematical calculation, decides ultimate outcome. Silver's journey from $30 to $116 to $99 represents 3 acts of longer narrative still unfolding. The conclusion remains unwritten, the trajectory uncertain, the volatility guaranteed. Only conviction navigates uncertainty. Only strategy survives chaos. Only patience realizes generational wealth.